Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Dan Dicker, CEO and President of MercBloc. Dan, thanks a lot for coming by.
Thanks,
Always
Mike.
great having you. Now, I've been reading some of your stuff recently, and you have an outlook on commodities. I wouldn't say it's very bullish, but why don't we get into that right now? Let's talk about the signs that you're seeing out there, which give you sort of a pessimistic outlook on not so much commodities. You're using commodities as the barometer.
Exactly. I don't want to take all the commodities and lump them in a category, because obviously, most of the energy products are their own animal, and they're difficult to put into this product, but into this category that I kind of see. But I've never seen a recovery except for this one, where we didn't have a solid rise in the prices of base metals to go along with what's been an increase, for example, in housing, which we've had, and an increase in aerospace, which we've had, an increase in auto sales, which we've had. All those lovely signs are usually accompanied by commodity appreciation as well. And for the base metals, particularly for copper, which we call Dr. Copper because it supposedly gives us an idea of how the global economy is doing. We've basically had a flat line since 2009 of a price between, basically in the low $3 a pound range. And I personally believe, if not for the Chinese supporting that market, which they clearly do in a shadow banking way and with stockpiling, that we'd see prices sub $2 a pound in copper, and that's not a good thing for me to see, and it hasn't been a good thing for me to see, particularly now that at least we're talking honestly about a pulling of the parachute on the Fed, a taper that so far is not much of a taper, but at some point will increase in speed, with real interest rates that are necessarily going to go higher. All of those things may say that what has induced a fairly frothy stock market here may in fact be telling a different tale in terms of the commodity prices that I'm seeing.
But now, I think it seems you're making a distinction between the stock market's performance and economic performance, because if I look at economies generally, globally, commodities are telling us exactly what the story is. We have fractional growth, if that, in Europe. Okay, we have growth here, which we had a decent quarter, but now they're already revising first quarter 2014 growth down here. Okay, so if you look at actual economic, performance, it hasn't been that great, which would equate to this kind of subdued price action in commodities. Now, if we're talking about stocks, what are stocks? I mean, you're really talking about corporate profits. And despite the environment, right, you could argue, I guess, that companies are still able to squeeze out a profit level that makes investors, interested to get into the stock market. So maybe the story, what I'm trying to say is maybe it's the stock market we should be looking at that's giving us the wrong story here. And maybe commodities are saying, hey, it is what it is as far as the economy goes.
Well, that's the point. And I think that stocks, after doing what they can in squeezing, the bottom line, need at some point to rely on top line growth. And again, without a robust commodity, without a robust growth figure, also from the emerging markets as well as in Europe, as you say, at some point we're going to have to pay a piper here for what has been, I think, to a certain degree, Fed-induced kind of increase in the EPs that we're paying for stocks. Those have to sort of come home to roost at some point. Again, it all depends on a taper and how fast it happens, and when real interest rates really do begin to rise, especially further out on the curve. And that's difficult for anybody to judge. I just look at something that's flatlined in terms of a copper price. I'm worried. It frightens me.
Yeah. But, you could take the contrarian view that we could have had this argument, the opposite argument, several years ago when prices were boiling, right, and saying, oh, there's going to be this robust growth, and, it didn't work out that way.
Indeed.
Now, I want to pick your brain a little bit about energy, because that's your specialty, and crude prices are pretty high right now.
Natural gas, we saw $6 today for the first time since 2005 or 6.
And I think you and I spoke about natural gas the last time you were here, and I've been saying that this whole opening up the export market, and I think you agreed, is going to cause this kind of giant arbitrage to cause domestic prices to trend towards, global prices, which are 2 to 3 to 4 times higher.
Right.
But what about the energy? If the economic growth is still kind of subdued, what is and we're supposedly having all this new output, U.S. is an exporter. What about the oil?
Right. Well, let's take one at a time. Let's start with crude oil. I mean, there has been at least the logical thought in the fourth quarter of 13 from a lot of the oil analysts was that exponential, parabolic growth of crude shale plays in the Bakken, the Eagle Ford, and in the Permian Basin, particularly the Wolfcamp, was going to lead to a glut in domestic crude oil. Add to that what I think will be an approval of a Keystone pipeline and more oil sands coming down from Canada. And what most of the analysts expected for 2014 was a cratering price in crude oil. Now, that hasn't happened, and I was one of the people in the last year who screamed that it wasn't going to happen. It's not going to happen, and you're not going to see it. What we have is, although we have a dichotomy of oil production, in the United States we clearly have marginal growth, enormous marginal growth from shale plays in crude oil. But around the globe, the story is entirely different, and we can talk we can go geopolitically from country to country in the Middle East, but
Saudi,
again, right?
That's the
Saudi is
key.
Well, Saudi is at a full tilt boogie at 10 million barrels a day.
But they could offset any new production by cutting back.
That may or may not be true. They can cut back, but add is no longer an option anymore. There's very little left in reserve production that the Saudis have to draw on. Now, if you start to add, if we can talk a little bit geopolitical, we start to add about the mess in Libya, the mess in Syria, the mess in Iraq, the coming mess in Iran, Egypt. If we look at some of the other hot flashpoints, even in Venezuela and Nigeria, and we look at how much more difficult it is to gain decent leases to do offshore drilling in Mozambique, in Vietnam, offshore in New Zealand. I mean, we could go around the globe and I could pick at you and show you where it's getting more and more difficult to create new production and new barrel reserves. It's a total opposite story to what's going on in the United States. Now, that really matters because as much as we're gaining production in the United States, it amounts to maybe a million and a half, maybe over the course of 3 years, 2 million barrels a day of production in the United States. Still a relative drop in the bucket to a global economy that requires close to 90 million barrels a day to keep going. So it is marginal production, and that number is growing, by the way.
If economic growth picks up.
It's growing anyway. I mean, even with the slow growth that's going on in emerging markets and elsewhere, that number is picking up. It does pick up relatively 10 million barrels a day over the course of a decade. It has for the last 4 decades. It's on pace to do it again. I mean, those numbers don't go down. So if you have a decreasing look for a global oil outside the United States, sometimes you can get a little U.S.-centric and look around and say, wait a minute, well, how come prices aren't going down? Well, they're not going down because the United States is really an outlier right now in terms of production.
So the contrary, and it's kind of interesting because it's flipped back and forth in the last 6 years a couple of times. In 2008, we hit 150. Everybody, that's the end. It was its peak oil. It's finished.
Right.
We're going to 200. I even think Goldman put out something about $200 oil back then. We went all the way down. Of course, we had the financial crisis and the market crash. And then the big story about Bakken and North Dakota and Eagle Ford and all this new production. And hey, that's it. The oil crisis is over. Forget about peak oil. And now it's kind of like, hey, we're going back there again.
Right. I would carve the onion a little bit because it's not really peak oil. This is not really about reserve barrels. This is not about potential barrels. Potential barrels happen to be off the charts. I mean, peak oil truly is a dead theory, at least right now. Not that it's not it's not a limited number of barrels that are in the ground, but right now what's being found clearly outstrips whatever anybody thought would be found. The point is about getting it out of the ground, what it costs, the geopolitical risks risks involved, and what governments want to extract from E&P companies to get it out of the ground. And all of these things, they fix themselves, and they only fix themselves as the oil price goes up. I mean, that's what's clear. What's clear is that, you know, if you've got $75 oil or global $70 oil, there's a lot of recoverable barrels that nobody wants to recover. But once you get oil into the 110, 120, 130 area, all of a sudden that deep water project off the coast of Mozambique looks pretty darn good, and that's when the production starts to hit.
So I guess what you're saying is us consumers, you know, we better be prepared for some higher prices.
I think that, you know, there is, and I've done this
while you can.
I've done this for Business Insider. I think the most important chart in the world is the chart of running crude oil prices, and it shows a upward trend that has been unchanging since 2008, since the financial crisis. Looks like it's solid as a rock, and if I was betting on one chart, that chart tells me you're going to see every year higher lows, higher highs, a number that continues to increase. Again, the lows in 2010 were $70. The lows in 2011 were $82. The low in 2012, $92. This year, you won't see anything, you know, below $95, $96, and you know, and it keeps on going. You'll see prices. Again, this year you'll see spikes into the 120s, but you'll see an average price well above $100 a barrel. That's my belief.
All right. Well, not a pretty picture, unless you're long oil.
Well, or unless you're long American exploration production companies, in which case you're minting money, and that's the best way to hedge against the high oil price. Buy oil stocks.
All right. Great point. Thanks very much, Dan. Always great
Mike.
to have you. That's it for now, folks. We'll see you next time. This is Mike Norman saying bye-bye.